No one saw it coming, at least. That's what they claimed. But the truth is, the danger had been visible for years, sitting quietly beneath the surface of Asia's booming economies like a fault line waiting for the slightest pressure. The Asian financial crisis wasn't just a collapse of currencies or a panic in stock markets. It was the moment the world learned that emerging markets, with all their glowing promises and rapid growth, can crumble faster than anyone expects and drag the global economy down with them. And the biggest mystery is this: how did a collection of countries that had been called the miracle economies suddenly become the center of one of the most violent financial implosions in modern history? To answer that, we need to go back to a time when optimism in Asia was so high that no one questioned whether it might be built on a trap. Throughout the 1980s and early 1990s, Southeast Asia was a financial paradise for international investors. Countries like Thailand, Indonesia, Malaysia, and South Korea were growing at blistering speeds 8, 9, sometimes even 10% a year. Western economists called them tigers, global banks called them can't-miss opportunities, and governments across Asia called it proof that they had discovered the formula for endless prosperity. Everyone believed the same story: strong exports, cheap labor, rapid industrialization, and foreign investment flowing in like a river. What could possibly go wrong? On the surface, nothing. But beneath the glossy skyscrapers and the ecstatic headlines, these countries were quietly constructing economies built on a dangerous foundation: short-term foreign debt, fixed exchange rates, and a financial system that was expanding faster than anyone could regulate. It's almost ironic: while newspapers were celebrating Asia's success, the seeds of collapse were already being planted one risky loan at a time. Foreign investors, convinced that Asia was unstoppable, poured billions into local banks. Local banks, eager to ride the wave, lent aggressively to real estate developers, corporations, and governments, often without considering whether the debt could ever be repaid. And because many Asian currencies were pegged to the US dollar, everyone assumed exchange rates would never change. Borrowing in dollars seemed safe. Lending in local currency seemed even safer. It was a world where confidence replaced caution, but confidence can be fragile. And in 1997, all it took was a crack. The first crack appeared in Thailand. Investors had begun noticing something odd. The Thai economy, once roaring, was slowing. Its real estate market was overheating. Debt levels were skyrocketing. Exports were losing momentum. And the Thai baht, proudly pegged to the US dollar, looked increasingly overvalued. Currency traders began betting against it, launching attacks that exploited any hint of weakness. Thailand tried everything, spending billions to defend the baht, raising interest rates, denying the presence of a crisis. But markets weren't convinced. In July 1997, under unbearable pressure, Thailand did the unthinkable. It abandoned the dollar peg, letting the baht float freely. Within hours, the baht collapsed. Within days, panic spread. And within weeks, the shockwaves were rolling across Asia like a financial tsunami. Investors who once believed Asia was invincible suddenly rushed to pull their money out, first from Thailand, then from Malaysia, Indonesia, South Korea, and beyond. Contagion, once just a theoretical concept in economics textbooks, became painfully real. Countries that had nothing to do with Thailand's problems found themselves drowning in panic anyway. Currencies fell by 20%, then 40%, then 60%. Stock markets crumbled. Banks collapsed. Corporations imploded under the weight of debts they could no longer service. And governments, once proud symbols of rapid development, found themselves begging the International Monetary Fund for emergency loans. But the true breaking point wasn't just the numbers. It was the shattering of a belief system. For years, everyone assumed that emerging markets were destined to rise indefinitely. Suddenly, that illusion evaporated, and in its place emerged a harsh reality. Rapid growth can hide enormous vulnerabilities, and foreign investment can disappear faster than it arrives. In Indonesia, the situation turned catastrophic. The rupiah's collapse triggered political chaos, street protests, and a full-blown economic meltdown. Banks failed by the dozens. Corporations defaulted. Millions lost their jobs. Supermarkets emptied out. Savings evaporated. The president, Suharto, who had ruled for 32 years, was forced out of power. A financial crisis had transformed into a national crisis. In South Korea, giant conglomerates Kibols like Daewoo and Kia fell under mountains of debt. The government had to secure a $58 billion bailout from the IMF, the largest in history at that time. Korean citizens famously donated gold jewelry and family heirlooms to help the country repay its debts. It was a moment of national humiliation and unity. Malaysia, refusing to bow to the IMF, chose a different path: capital controls. It locked money inside the country, froze the currency, and prevented foreign investors from pulling their funds. Critics called it reckless. Supporters called it bold. But it worked well enough to stabilize the economy before panic could escalate further. Every country had a different experience, but all shared one thing: the realization that foreign money is loyal only until it gets scared. The fallout was global. Western banks that had lent heavily to Asian companies suffered massive losses. Commodity prices plunged. Russia defaulted on its debt in 1998, partly due to the shockwaves from Asia. Hedge fund long-term capital management, run by Nobel Prize-winning economists, collapsed spectacularly because its models failed to predict how correlated the global markets had become. The Federal Reserve had to orchestrate a rescue just to prevent a worldwide financial meltdown. In other words, a crisis that began with currency traders in Thailand almost brought down Wall Street. And here's the twist most people never hear. The crisis didn't end because Asia suddenly found stability. It ended because the panic reached such extreme levels that markets simply had nowhere left to fall. When the IMF stepped in, when governments restructured debt, when currencies finally stabilized, the panic eased, and slowly, painfully, Asia began to rebuild. But even as economies recovered, something else happened, something quietly setting the stage for a future crisis. Global investors had learned that emerging markets were risky, but they had also learned that when the risks go wrong, the IMF will step in. Suddenly, there was a safety net. And a safety net can create its own kind of recklessness. The very institutions meant to restore order had introduced a moral hazard. If investors believed that governments or global organizations would rescue them, they might take even bigger risks next time. Fast forward to today, and the echoes of the Asian financial crisis are louder than ever. Debt levels in emerging markets are now higher than they were in 1997, much higher. According to recent data, emerging economies collectively hold more than $100 trillion in debt, triple the levels from the late 1990s. Many are once again dependent on foreign borrowing. Many once again peg their currencies, either officially or unofficially. And many once again rely heavily on short-term capital flows, the same explosive fuel that ignited the 1997 collapse. Take China's real estate crisis, or Turkey's currency volatility, or Argentina's recurring defaults, or the rising debt risk in frontier markets like Sri Lanka, Pakistan, and Ghana. The same ingredients keep reappearing: rapid growth, easy money, overconfidence, and fragile financial systems. It's as if the world learned the wrong lesson. Instead of asking, how do we avoid this danger entirely? Many countries concluded, we will simply grow fast enough that the danger won't matter. History doesn't repeat, but it certainly rhymes. If the Asian financial crisis taught us anything, it's that globalization ties economies together tightly enough that a problem in one region can quickly become a crisis everywhere. Investors chase returns across borders. Corporations borrow in currencies they don't control. Governments promise stability they can't guarantee. And underneath it all lies the same fundamental truth that Asia discovered in 1997. Confidence can evaporate in a heartbeat, and once it disappears, even the strongest economy can collapse. So what are the lessons we should carry forward? First, rapid growth is not a guarantee of safety. In fact, the faster an economy expands, the more carefully we should examine its foundations. Second, foreign debt can be a powerful accelerator when times are good, but a brutal weapon when times turn. Borrowing in someone else's currency is easy. Repaying it during a crisis is nearly impossible. And third, financial systems are only as strong as their transparency. Hidden risks, concealed debts, and opaque lending practices can turn small problems into catastrophic ones. The Asian financial crisis may feel like a story from another era, but the warning it carries is timeless. Emerging markets still depend on foreign capital. Investors still chase high returns with little regard for local risk. And globalization still ensures that when a major economy stumbles, everyone else feels the tremors. Which raises an unsettling question. If another crisis of this scale were to erupt today, one driven by even larger global debts and even faster capital flows, would the world be able to contain it? Maybe. Maybe not. But understanding 1997 is the first step in recognizing the warning signs. If you found this deep dive valuable and want more stories about the hidden forces shaping our financial world, make sure you hit the like button. It really helps support the channel. And subscribe so you don't miss the next investigation into the events that changed global markets forever.